Welcome back to She Talks Money, the podcast where we talk all things wealth, income, investing, and making empowered decisions that move you forward. I'm your host, Jennifer Butcher, and today's episode is for anyone who's looked at the headlines, seen mortgage rates, and thought, should I wait? Is it still a smart time to buy? Well, we're answering that and a lot more with someone who knows the mortgage market inside and out. I'm joined by Casey Delinsky, our company's Senior Vice President of Capital Markets. He's the guy behind the curtain, watching rate trends, investor behavior, inflation data, and helping our team understand what's happening in real time. So whether you're a potential home buyer, a homeowner thinking of refinancing, or a real estate agent guiding your clients through uncertainty, this episode will give you real answers, clarity, and confidence. We'll talk about where rates are headed over the next 3 to 6 months, the why behind rate movements, hint, it's more than just the Fed, what a 0.25% change really means for your monthly payment, and how to frame this market as an opportunity, not just a pause button. Let's get into it. Welcome to the show, Casey.
Thanks, Jen. Good to be here.
So we're starting out with the $1 million question. Where do you think rates are headed in the next 3 to 6 months?
Yeah, that's a tough one. I think with everything happening in the economy right now, it's going to be a very bumpy ride for the next 3 to 6 months. But I do believe that rates are going to get a little bit better starting about 3 months from now. I think we're going to trend that way for a little while, but it's going to be a very, very bumpy road.
I've told clients, be ready for a roller coaster ride. There's going to be ups and downs, and we're just going to try to catch the locks on the downs. Exactly. So what is currently driving all this volatility and stability?
A lot of it is uncertainty. You know, the Fed has been, their strategy is changing. The economic indicators that they use to make policy have been very erratic. Inflation is very sticky and they can't get rid of it no matter what they do. The labor market is significantly stronger than it should be under the circumstances. When you put all those things together, the Fed doesn't react as quickly as they'd like them to be. And it's making rates stay higher for longer. The other thing that is causing uncertainty is the current administration. Tariffs are a big one. No one really knows exactly what that's going to do to the economy, what it's going to do to inflation, and those are big points for the Fed and what they do with rates going forward.
Okay. So in this situation where it's really, really volatile, do you think it's better to lock now or float, and what risk does that carry?
Yeah, I think it's always better to lock when you know your monthly payment and you know you're going to be able to afford it. If you wait and rates go up, are you okay with $50 a month more for your payment? Is it worth waiting for that risk where you might save $25 a month if it goes the right way? You could lose a lot more than that every month.
I always say that to clients. Are you I present it to them and they get to choose, but I'm like, are you going to be more upset if rates get better by 1/8, or you end up with a 0.5% higher in interest rate? You know, you know, which one? Which way do you want to play it? How risky do you want to be? So that's a good point. So how can I explain to borrowers the difference between our rate sheet and what they might see online? So for example, I might be talking to a client about interest rates, and they say, I saw on, I won't give particular sites, but I saw an X rate, which seems like completely obnoxiously low online. Why are they seeing that, and what's the difference?
Sure. I think sometimes it's a little bit of a bait and switch. Sometimes. More often, it's they don't have all the criteria that you have as a borrower. They have some information. They use that information to estimate where your rate's going to be. But you're also dealing with people on the internet, and the loan officer might be someone, on some other state, somewhere across the country that you're dealing with. You're not going to get the service you want. I know our loan officers, they answer the phone at 9 o'clock at night. They do what they have to do and take care of the borrower, where someone on the internet might not do that.
I often say, you're giving up a lot of customer service sometimes if you want. And honestly, people can call and, they ask me what the rate is. What rate do you want? You can have any rate for the most part that you want, right? And so a lot of times those rates come with discount points that are in the super fine, tiny print down at the bottom that people don't pay attention to. So at the end of the day, you have to look at all things, right? Rate and cost, and then choose what's going to fit into your budget. So speaking of rates, what is the real impact of a 0.25% rate, let's just say, move on a borrower's monthly payment?
Sure. So in today's market, a quarter market move costs you on a $300,000 mortgage about $50 a month.
Okay.
Yeah, plus or minus $50 a month.
Okay. So how do you think that impacts somebody's long-term wealth plan?
Sure. For me, I always look at this as a cash flow basis, right? Your monthly payment is X. What are you going to do with that money otherwise? Right. So long term for me, I'm a guy who will always have a mortgage. When I refi, I go into another 30-year loan. I don't care about how long it goes because I know I can make more money in the stock market by taking that money, investing it, than I can than I'm paying on my mortgage and interest.
Right. I love that. And when you think about cash flow and comparing it to your investments, that's huge. It's not just one or the other. You have to look at the whole wealth planning picture.
Exactly.
So that's a great point. Why do you think home ownership is still a smart move in a higher rate environment?
I think the easy answer to that is looking at what rent costs you.
Yeah.
I think today, in 2025, the expected 2-bedroom rent is about $1,650 a month. Today, on a $300,000 mortgage, it costs about $1,850 a month. For $200 a month, you have your own house, you build equity. If you look at it over a long-term basis, over 30 years, all of the rent you paid versus the extra you paid on your house, if you sold that $300,000 house for $70,000, you would still break even.
That's such an eye-opener when you think of it that way, right? And it's not going to sell for $70,000. It's going to sell for significantly more,
way
and
more,
contribute to your wealth and your retirement. So that's a great way to put it. So how do you think that these rising and falling rates impact a buyer's purchasing power?
Sure. So again, $50 a month for a quarter point in rate, right? If you look at, qualification basis, DTI, things like that, that 0.25% in rate barely moves the needle, right? It's a lot of other factors that are involved. So I don't think it's that huge of an impact. Obviously, $50 a month is a make it or break it for some people, but for most people, it's not going to cause a problem.
Right. And I think that we were both in the market when, say, a few years ago, when interest rates were insanely low and it was a buying frenzy. So we have these people who are still on the fence saying, I'm going to wait for interest rates to come down a bit. What they're not realizing is it's like walking into a Black Friday on Target and they're selling like TVs for $100 or something. You know what I mean? Like, it's an insane buying frenzy. And the cost of that house now just got higher, which is going to have a much bigger impact on your monthly payment than a little bit of an interest rate right now.
Yeah, and if you think about it that way too, if you're on the fence and you're waiting, the increase in house price that you might experience over that time waiting for rates to come down costs you more than just buying the house now and paying the higher rate and then refinancing later.
Because you've already built up equity too. Like I try to tell people, and it's one thing coming from me, but I feel like we are in this little special pocket right now that I know it's hard to believe that home prices are just going to continue to go up, but I know you are a data person just like myself. And when we look at, the average age of a first-time home buyer, 33 to maybe like 36 years old last year, and you go back that many years and look at birth rates, right, which significantly went up for several years, which tells us the demand isn't going anywhere. Like, there are just more and more home buyers that are going to continue to come into the market in the years to come, which is going to cause demand to go up. So home prices really are going to continue to go up, and to be able to get in now while there are people waiting on the sidelines, and maybe home prices are negotiable, or you might find a deal or whatnot before there's that buying frenzy and they go up quick. Then you already own when that frenzy happens and your neighbor's house goes for 20 or 30K over list price, and you just get to take advantage of that instant equity. This is a great question for today because it is a wild day, and I know this is posting later on, but it's a crazy day in the market right now. So can you walk me through how quickly we're adjusting our pricing in this market and how it helps us stay competitive?
Yeah, absolutely. So for us, we only update rates when we need to and as fast as we need to. I think today we've had 4 different reprices already. What that does for us is, as a loan officer, you get frustrated because pricing changes all the time. But what that means for a borrower is that we usually give a better rate than some of our competitors.
Right.
When the market's doing what it does today, people get conservative. They price themselves in a way that continued declines in the market isn't going to hurt them. And we don't do that. So it's helpful to the borrowers, can usually get a better rate as long as you guys act fast. And we try and do that in positive and negative markets.
Well, I know that causes you a lot more work, but we we appreciate it on the loan officer side for sure. So how do you see rates trending into the next season? So maybe summer, fall of this year and into 2026. Show us your crystal ball, Casey.
Sure. So I think, again, with the bumpy ride that we're going to have in the short term, long term, I think there's going to be some stability. I'm not sure exactly how long it's going to take to get there, but I think once we reach stability, rates will continue to come down. That uncertainty factor is always one that creates higher rate environments. The way the mortgage market works, if you have a lot of volatility, the different coupon spreads and how the stack all puts together, it changes how much someone can get paid for a specific rate. And as the market settles down and you find stability, those things kind of widen out a little bit. You see a price difference between two different rates, and it's in today's market relatively small. It's cheap to buy down a mortgage today if you're in the higher rate tier. That'll spread out, and what that does, it ends up with better rates for customers.
Sure, awesome. That's good news. Can you share your wisdom for the people who are living in fear right now? So I just got a call this weekend from a real estate agent asking for my advice because she had a client that was about to build, $1 million house, and they all of a sudden wanted to put a pause on it because the markets are kind of going crazy right now.
Sure.
Probably watching their 401k,
Yep.
Their investments drop, and they kind of go into panic mode.
Yep.
What do you have to say to those people about stability?
Sure.
Honestly, the stability housing kind of offers right now, I feel like it is one of the more stable investments.
If you look at it from an investment basis, there's been a couple of time periods in history where home values have gone down, right? Don't say never, because it's not never. But when people walked away from their houses, back in 2007 and 8, I think those people were crazy.
Yeah.
Just because you're underwater today doesn't mean you should walk away from your mortgage.
Right.
All of those people, if they would have just kept paying their loans, they would have made all their money back in a year and a half, and everything would have been fine. The economy wouldn't have imploded, and everything would have been better for everybody.
I still own a house from that time period. I watched it go down $100,000, and guess what? It's $100,000 more than what I originally paid for it now. So.
Yep. And it's the same thing with people on the 401k side. In 2007, 8, and 9, I was working at UBS as a financial advisor. I watched people go, a little crazy with everything that was happening back then. Yeah. It was a scary time. That's the time that I see as an opportunity. Right now, it's an opportunity. The stock market's kind of imploding. We're down 16 some percent over the last, month and a half, 2 months.
Yeah.
And that's a significant opportunity for us. If you put money, if the market goes down 50%, it takes 100% from there to get back to where it was. So any money you put in at that point, you've doubled. You get all your original money back, and you come out ahead. I look at times like this as an opportunity. There's no reason to be scared.
Awesome. I love that. What economic indicators should agents be watching, and why do they matter? So let's talk about this, because I want to record it. And the next time I hear a client or an agent say, well, the Fed's dropping the rates, so interest rates are going to come down. And that is part of it. Don't get us wrong.
Yes.
But share with us a little bit more on that
Sure.
topic.
So keep in mind, the Fed is a short-term interest rate. That's an overnight borrowing rate that has very little in the long run to do with mortgage rates. Short-term rates matter. What the Fed does matters for mortgage rates. Again, it's long-term, though. It's not, today, if the Fed says tomorrow they're cutting rates next month, that doesn't mean much outside of the emotional impact that it has on people and traders around the country. That emotional impact is much larger than the Fed actually changing rates. And usually the market is well ahead of this anyway. The market is betting daily on what the Fed's going to do.
Yep.
And they look at every economic indicator on the planet to try and figure it out. And they move ahead of the Fed's announcements anyway.
Right.
So when the Fed announces a rate cut, the market's already adjusted for it. Okay. So talk about the Fed a little bit and what they're doing. Their mandate is maximum employment with price stability, right? So inflation and labor market.
Right.
Those are the two biggest things to look at today when you're talking about what's the Fed going to do. If that's what you're worried about, what's the Fed going to do? It's always labor market and inflation. Inflation's sticky. It's hanging around. It's higher than anyone would like. Tariff policies from the current administration aren't going to help that. It's going to make it significantly worse, which is the interesting part of things like today, right? We had a a fake news incident today that caused the market to go a little crazy. Stock market sold off hard in the morning. Bond market sold off hard in the morning. And then it was determined to be fake. The White House said, no, we don't have any plans to pause the tariffs we're implementing. The stock market came back quite a bit, but the bond market continued to sell off, right? If the market was reacting appropriately to tariffs being paused, the market should have, the bond market for mortgage rates should have increased, not decreased, right?
Yeah.
We had the opposite reaction. So again, emotion is a big piece of this. What I think a lot of people don't take into consideration when they're talking about stock market, bond market, anything, is they don't always run on fundamentals. They don't always run on the data. So when you get a very emotional group of people together and they start determining where the markets are going to go and how they feel, we get days like today.
Yeah. I think it's really important to stress here to not only consumers who are buying or homeowners that own a house, but also our real estate partners who are having these conversations directly with client, is take the conversation away from interest rates necessarily, because rates change, as you can tell, as Casey's mentioned, sometimes 5, 6, 7, 8 times a day. And it's more about monthly payment. I get asked all the time, is it the right time to buy? I'm a real estate investor, and I've never timed the market perfectly.
It's always the right time to buy.
And I do this for a living, right? I do this for a living. So it's not about is it the right time to buy? Is it the right time to buy for you? Are you ready to be a homeowner, or are you ready to move up to that next house? Where is your lifestyle and what do you need in your life? And then being really realistic about your cash flow and your monthly expenses and what can you afford on a monthly basis. Maybe you're moving out of a house with a really low interest rate and it's scary to take on a higher payment at the rates that they're at right now, but have you considered renting out that property and increasing some cash flow? Hold on to that. It's all about having a conversation with an advisor like myself and being educated on your monthly expenses and cash flow and what is going to work for you, what is going to work for you and your lifestyle, and can you make the payment work? Interest rates will take care of themselves. Wherever you end up, you can refinance later on. At the end of the day, we know for the most part, home ownership is going to increase your wealth significantly in the long run. So,
absolutely. You can always refinance later if rates are high.
Absolutely. Well, this has been awesome and very insightful to have such a wise mind. I will admit that whenever I have questions on what the heck is happening with interest rates and what's going on, Casey is my very first phone call. Please explain this to me in English. So I appreciate you being on the podcast today.
Very well.
And I hope this episode helped cut through the noise and gave you practical tools to understand what's really happening in today's market. And more importantly, how to navigate it like a wealth builder, not a worrier. If you're a buyer, this is your reminder. You don't need to wait for the perfect rate. You need a strategy that works right now with room to optimize later. And if you're a realtor, you're not just selling homes. You are helping people make one of the biggest financial decisions of their life. So let this info give you the edge and confidence to lead. If this episode was helpful, share it with a friend, your real estate team, or someone who's been sitting on the fence. And don't forget to tag me at Jennifer Butcher Mortgage with your favorite takeaway. Thanks for tuning in to She Talks Money. I'll see you next week with more smart strategies to grow your money, protect your energy, and build your legacy.